Good afternoon. This is Chris Robinson, Robinson Ag Marketing, with today's closing grain and livestock comments. Well, a bad day at BlackRock for the soybeans. 7 month lows. We'll lead off there. August finished down 14 cents at 967 and three quarters. 964 is the contract low, which takes us back to December. So that's an issue there. The beans are under pressure. Did not like the news out of China. China was actually exporting bean oil to India. China has so many beans. They've over they've obviously gotten too many beans from South America, and that just means that it's less and less of a demand issue moving forward for the U.S. So that definitely put beans under pressure. New crop soybeans couldn't finally gave up the ghost at $10. Finished down 13 and three quarter cent at 995 and three quarters. The number to worry about, I'd say, is the 970 low, which is what we hit back in April when they came out with the tariffs. But if you remember that, I mean, that was a terrible move down to 970. But then we did have one last hurrah into June where we rallied up to 1075. That was a $1.03 rally. And if you were following along with me at the time, I was screaming and yelling, banging the pots and pans. If you don't believe me, you can go back and look at all the emails. It's out there. It's all my tweets, everything. I was trying to get guys to reward that rally, and so some of you did, some of you didn't, but you never know. So that's the risk I think right now. When we're at 995, it's 970, and then the contract low is 960. That goes back to December of last year. So there's probably 30 to 40 more cents worth of risk in the beans if you ask me what's the downside risk. Flipping up the corn. Corn did manage a higher settlement barely. These corn up 1.25 cents at 412 and a quarter. September corn up 2.5 cents at 391 and three quarters. We've seen this before. We made lows yesterday. December corn, if it takes out 407 and a half, I think you'll see more selling coming in there. Today, it just felt like to me they covered a little bit. They bought some corn as they were selling all these beans. They really pounded on the beans today. The low previous day for sep corn was just a tick below where we were today. We traded 387 and three quarters. The number I'm worried about for spot corn, you got to start going back and looking at old lows. Okay, so you got to go back to September 11th of 2024. We traded 377. And then if that does not hold, then we're back to the contract low there at 360 and a half. That was in August of last year. So, and that again, that's for spot corn, nearby corn, corn in the bin, whatever you want to call it. That's a completely separate issue than new crop corn. New crop corn at 410 here. We haven't had a lot to work with in December corn this year. The high was 479 and three quarters. And to be down here at 407, I mean, 75 cents. We had 2 or 3 years where we were used to 50, 60, 80 cent dollar moves. So 2025 has been a challenging year, absolutely positively. The next risk I'm worried about is the August 12th USDA report. I can remember 4 or 5 years ago, one of those reports was so bad. I was listening to Orion Samuelson on the radio, and he was saying literally that they should get rid of that report because it doesn't serve any purpose. Well, that's because it was a kind of a bad report there. So that report does represent risk. It's up to you whether or not you want to manage it or not. But you've got a certain date on the horizon where there's risk and there's opportunity. I'm not saying we can't rally, but boy, you don't want to get hammered if it's a bad news, especially when we're sitting down here at 410, 412. In the wheat, just more pressure there as well. September wheat, Chicago wheat finished down at down 6 cents at 523 and three quarters. If it takes out 521, that's going to be taking out the May contract lows. Kansas City wheat did manage a 3.5 cent rally. Finished the day up 3.5 cents at 522. So far, the contract low there, going back to May, 515 and a half has held. We've tested it 2 or 3 times here recently. But I think if that was to come under pressure, you may see more sell pressure. Minneapolis wheat made a new low, new contract low, 575. If 575 fails, it opens the door up to 555. That will be the next progression I'd be concerned about. So if you're long wheat, get yourself a hedge. You don't want to, seal the deal. You don't necessarily want to sell cash down here. If you do, then make sure that you look into re-owning those things because there's nothing worse than selling bushels into the contract low and then a month or two later, we've rallied back. So because of the risk, that's why we hedge, and that's what I've built my program on. That's what I built, the entire way I try and work with farmers on is let's just keep your risk on paper. Let's try and stay in a situation where we can reward rallies, make good cash sales when we want to. But I'm not kidding you. I know 2025 has been a very, very difficult marketing year. When you trend lower all year, there's not much to write home about. So I understand. We're looking at it every day with you. Now on the flip side, the cattle market new highs again today. August fat cattle hit 233.75. That's a new all-time high. August feeder cattle hit 339.70. Again, a new all-time high. August feeder cattle has rallied $40 in about 5 weeks. Just incredible. And to boot, the managed money, they've been record long, about 55,000 contracts. So you do the math. What's 55,000 contracts? $500 a penny for 40 pennies. It's quite a bit of dough they've made. At some point, they may hit the sell button just to put in those profits. Tomorrow's the last day of the month. We'll see if that changes anything. You did see some lower cash trades. Some box beef trended lower. There's obviously a lot of stories out there about the Packers now, whose margins are in the red. I don't know how much longer this is going to go. The cattle market has been on such a tear that it could correct 20, 30, 40 bucks and still be in a long-term bull market. The market's overbought. Just like that gentleman said, the famous quote, the market can remain irrational a lot longer than some people can remain solvent. So that is something to remember. When it does turn, I think your best strategy is to have a put option, because the put option gives you a floor, lets you capture revenue, but also leaves the upside open. So if you're unhedged, if you've got a bunch of animals in the field and you're looking at it, it's the most expensive cattle we've ever had, get yourself a put. It would be like having a house that you paid $100,000 for that's worth $1 million and you didn't bother to insure it. And how much of that, if you go from $100,000 to $1 million, how much of that $900,000 profit do you want to insure? That really comes down to it. And that's what an option can let you do. You want to insure all of it, it's going to cost more. You want to insure 80% of it, 60% of it, then you buy a put that is further under the market and therefore cheaper. So if you're not familiar with how options work, please give me a call. Robinson Ag Marketing, 312-638-8868. I hope these comments help you. I will say this, if you're concerned about stuff, especially in the grains, give me a call. There are some strategies here where we can start looking ahead for possibilities moving ahead, but also, being realistic. You got to be realistic in these markets. People that aren't realistic, I think they're doing you a disservice. This is Chris Robinson. Love to talk to you. Again, 312-638-8868. Have a great rest of the night.